Hello everyone, and welcome to today's discussion on income and budgeting for prosperity. At FMD Financial, we review people's financial situation across 6 different pillars, and we have created a series of webinars addressing all of these individual areas. For those of you that joined us last month, we talked about goal setting, and today we're going to focus on income and budgeting. These will be followed by webinars on assets and debt, superannuation, insurance, and your financial legacy. For those of you who do not know me, my name is Nicola Beswick, and I'm a senior advisor here at FMD. Today, I'm here with my colleague Karl, and today we're going to discuss these points around income and budgeting to achieve health, wealth, and happiness, and touch on some of the trends that we've seen throughout the coronavirus pandemic.
Yeah, hi, my name's Karl Hunting. I've been advising clients for 21 years, and today's topic's quite important, and it's probably the most important area of personal finance. So look forward to sharing some of those thoughts with you. Over to you, Nicola.
Now, before we start, a few housekeeping items. Today's session is being recorded and will be sent by email to registered attendees and available for you to watch and review in your own time or share it with family and friends. Karl and I will be able to answer questions at the end of the conversation. So please, if you do have any questions, pop them in the Q&A function that you can see on the screen. Type your question in the dialogue box and we'll get to the end and answer your question. There may be some questions that we might not get to today. So if we don't, we will get back to you with a response. And if you're having any difficulties, please refresh your browser and then reconnect. Again, we will be sending out a brief survey to all of the participants today, and we would really actually appreciate your feedback to ensure all of these events in the future meet your expectations and interests. And please note, we will be covering off various points in general. So if you have any specific questions around your own situation, please reach out to your advisor. Today's webinar, we will be talking through 5 particular areas. Firstly, we will cover some rough trends that we've seen both in income and expenditure in COVID-19, and then touch on cash flow management for those in different life stages, particularly those that are retired or heading into retirement. Finally, we'll build on some tips around building a surplus and have some really interesting points there for you to consider. I'll now hand over to Karl and he'll talk through some of the trends we've seen over the last 18 months to do with income.
Thanks, Nicola. Okay, let's talk through now. Obviously, the last 12 months has been horrific regarding wages and labour across the country. So the recent income trend has been on the downward side, particularly labour and wages in general. There's been a couple of industries that's bucked the trend, but overall, there's been downward pressure there. We've seen a reduction in dividends, more of a story of 2020. Dividends are coming back. There's better visibility from companies at the moment, and I think profits have actually surprised on the upside. But the recent income trend has been down on the dividend side. That'll bounce back. Rents have been lower the last 12 months, mainly in the metropolitan areas. Regional areas have actually gone up, but overall rents haven't been great. And that's all a feature of the lockdown and this really interesting time we're currently in. Lower term deposit rates. This is not a recent trend, probably the last 5 years. We've seen downward pressure on all fixed interest products, lower yields across the board, shares, property, all asset classes effectively mainly governed by the fact that monetary policy has been easing quite dramatically. Quantitative easing has also, provided that scenario. So we've seen lower deposit rates for retirees particularly, and we've seen lower account-based pension minimums governed by the changes that came about at the start of the pandemic. There's been a recent trend as well around conversion of capital to income. No longer, maybe 10 or 20 years ago, clients could live off 5% yield on a portfolio and organically just live off the yield. Yields have effectively halved the last 10 years. And so it does force some people into selling down property or other assets they wouldn't normally sell to try and create that income for spending. Let's have a look at a slide now that talks about the last 15 years or so. We can see the GFC there, that blip on the left-hand side. But since 2011, we've had a really good period actually of net worth, household income growth, asset prices in property, super, shares, you name it. It's been a really good period. And a little correction there, 2018. But obviously the pandemic, we saw markets pull back, and across the board there was a number of assets that went down. And the good news is it's come back, and all-time highs effectively at the moment in major indexes. This contributes to a positive wealth effect, and that's a really good thing for income. As we feel better about our own personal household wealth, we generally go out and spend and buy, and that flows through to higher incomes, and everyone's generally happy. But look at the next slide now. This next slide illustrates the expectations of income over the next 12 months. Now, left-hand side, we've got wages and income, or salaries, excuse me. Middle stanza there, government and Centrelink pensions. On the right-hand side, we've got other income, which is more passive income, trust distributions, dividends, rents, everything not aligned to exertion income. If we forget the navy blue there and really look at the orange versus the light blue, it paints a pretty strong story about the expectation of income over the next 12 months or so. And I think the key of this slide is probably the left-hand side, wages and salary. Moving to the next slide. Again, this is an expectation of income over households over the next 12 months. The orange and the red represent an increase, and the light blue, dark blue, not so much, decrease. And quite clearly you can see there is a lot more orange and red on that board than there is the blue. So that bodes well for our next 12 months in our domestic economy. The slide now is similar to the last, but it's expressed as a dollar figure. And again, taking our eyes away from the navy blue, that's not really important. It's the amount of orange there compared to the light blue. And the orange easily beats that. And really the question at the moment we're asking ourselves is, when the economy does deliver this extra income to our households next year, in the next 6 months or so, are people likely to spend it, or are they going to save it? Are they going to pay down debt, or maybe they'll spend it on tourism? So it was really a challenge coming out of the GFC. It's been noted that the RBA has had several problems with effectively trying to get people bringing that income back into the economy and kickstarting some of the industries that really need it. So in summary, income for the next 12 months look quite healthy, and this bodes well for the positive wealth effect and our ability as people to create surplus and really get back to those big savings plans we all want to achieve. I'll hand it back now to you, Nicola.
Thanks, Karl. We'll now look at some of the trends we've seen around the expenditure and lockdown. And not really surprising, particularly when I think about my own household, we have spent a lot less on key things. Many of you listening today would like to get out and continue to travel because we haven't been able to in the last 18 months or so. And for those of you that are working, I know transportation costs have dramatically decreased. You haven't been spending money on that, along with updating your wardrobe, particularly over that time. But as we've all migrated into working from home, we have seen a lot of people spend things on their home, updating office equipment, updating their home furnishing, and also looking at those things that we really enjoy doing. We can't go out to restaurants anymore, so we are spending a bit more on food services, not only through the supermarket, but food delivery and convenience stores. One of the more interesting things that I think we're all keen to understand is what happens to some of the savings that we have had throughout the lockdown period. This chart, which is taken from a study throughout the COVID-19 pandemic and is based on the Australian economy over the last financial year, has some interesting statistics. The solid line you can see there shows that current household savings really, as a ratio to income, really spiked in June 2020. This, in fact, is the highest on record that we've seen over the last 20 years. Prior to this, there was a decline in savings rates, and many factors had been contributed to this. Some think it's to do with a weakness in wage growth, and also potentially taxes eroding what may have been a small income gain through this wage growth. The dotted line, the light dotted line there, shows the ratio of household interest repayments to disposable income. And we can see this has been a continuous fall, attributed really to the falling in interest rates, where people were not really saving a lot and repaying, but we have had a steady increase in this as housing repayment obligations did fall throughout the 1920 financial year. And we saw interest repayments as a ratio to disposable income average only around 6%. Not surprisingly, though, the ratio of household debt to income, as indicated by the dark dotted line, has increased over time. And this is really to do with what we've seen with in higher housing prices, but then also it's fallen back recently, and a lot of this can be contributed to the temporary repayment mortgages that have been deferred, particularly over that COVID-19 pandemic. And a lot of this data has been supported by what the Australian Bureau of Statistics has shown in this survey here. Now, this survey really shows what people have done, particularly households, around their short-term liabilities. Now, this is particularly credit cards and personal loans. And you can really see on that right-hand side there a decline in the short-term loan liabilities well before the COVID-19 pandemic. Households are clearly moving away from credit card and personal loans. But as we come out of the COVID-19 lockdowns and people are looking forward to the future, what are people expecting to happen in terms of their savings in the next 12 months? This chart here really shows us what people are anticipating to do. A lot of us, particularly those in Victoria and New South Wales, are expecting to have an increase in spending, particularly as we go back to normal or semi-normal life. We've got a majority of people expecting up to 10% essentially of their spending to increase in the next 12 months. So what are people spending their money on? We're looking at things predominantly like travel. Close to 32% of us are really looking forward to getting out and seeing the world and seeing Australia. I know I am. And others are also looking at renovating their home and using the extra money to repay their mortgage significantly more. What is probably more of interest to many of you listening today is the right-hand part there. About 2.5% of people are actually considering retiring. A lot of people I know have been working throughout the last 2 years, predominantly because there isn't really a lot to do other than work, and people have delayed their retirement. So as we all head into retirement, what are the key things that you need to look for with regards to making sure you can manage your cash flow through this time? Now, this is something that Karl will touch on for us now.
Thanks, Nicola. So I'm going to talk through now retiree cash flow management. And I advise every 5 years my retirees to look to, try and track your income and spending patterns. Definitely log those spending measures and exactly where's the money going. Most retirees probably don't. You probably don't like to use computers that much. I'm not sure about some of the apps. Some are good, some are bad. So I actually a bit old school. I really like to log it on an Excel spreadsheet or even paper, tally it up, and then multiply by 4. I advise you not to do this on the January, Christmas, February period. Daylight savings, longer time frames, you're buying more things, you're going on more holidays, a bit more lumpy. It's not really a true reflection necessarily on what you're spending your monies on. So if you aim for sort of spring or autumn, that's probably a good time to do that. And once you know, and it is confronting, you'll probably see some things that stick out, and that's the idea. It does hurt a little bit, and it's not easy to do. That's why you only do it every 5 years. So recommend you do that to get a real foothold on where the money's going. Retirees should also look to create defensive measures. With account-based superannuation pensions, particularly, to be over-invested into equities or portfolios where, every 3 or 4 years we do have that market correction, recession, you name it, where the worst thing to do is to really sell down those distressed prices and have to, take your money out of the market at that point. So having 1 or 2 years of income within a superannuation pension is a very smart manoeuvre. Doesn't have to be the case. You might have an emergency reserve outside of those tax structures, but you need to have those defensive measures in place. New cars, and you just don't know when you'll need to fix the house or whatever. Retirees should also look to lower their pension minimums if possible. There's no better tax haven really than that account-based tax-free pension. So the government currently has those measures in place for the next 9 months or so. And if possible, I'm advising my clients to, look to reduce that to retain more in their portfolios. Retirees, I really suggest that you don't delay gratification. The amount of regrets I hear, having specialised in aged care for a number of years, people getting to 85, 90 and really having too much left over, not ever travelling much or getting it out of the system, can lead to regret. And so I sort of say, make the most of the first 10 years of retirement. That's when you'll be the most active. And I sort of break it up into 3 stages. We've got early life stage there after retirement, which might be somewhere between 65 and 75. Middle stage, perhaps we look at the next slide now, which will better illustrate this. First 10 years, you can see there we're spending above average in retirement. And again, all retirees are different. There's no unique way about this, but these are just general concepts. In the middle period there, we've normalised our spending. There might be a quick renovation or 1 or 2 holidays, but it's not as busy period as those early stages. And the last stage there, in those last 10 years, generally speaking, we're not as active. We probably don't eat as much even, and a little bit homebound. But we have to keep our eye, obviously, on aged care. 3/4 of us approximately won't actually make it into permanent nursing homes, and that's where the exponential costs really rise. Obviously, having that understanding that you really may have that cost coming up, but for most of us, we won't actually get there. We look at this chart here on the left-hand side. There's an expectation most of us have that we're going to be spending thousands of thousands on our care needs as we get older, and it's probably going to be in this sort of linear or steady rising fashion. It's not the case. On the right-hand side there, you can see the reality is that the minute we do take that fall or we do have to go into hospital and then nursing homes, is that the costs really do escalate. So having an understanding of that helps us, I guess, to design the way we do spend in our retirement. If you look over the slide now, I want to talk to you now about a retirement strategy of income layering. Income layering is not for everybody, and this strategy probably suits people who are receiving or could receive Centrelink. So couples where they've got a home and they're less than 900,000 of assets, and for singles, less than 600,000 outside their home. This strategy is all about providing consistency, diversification of income types, protecting problems that can happen, and let's talk about it a bit further. So we've got in the bottom layer there Centrelink age pension in brown, middle layer in green income streams, which could be defined benefit superannuation pensions or annuities. This category really protects against longevity risk and running out of your monies. And there has been some recent law changes in the last 2 years which do allow for an increase of sometimes as much as 70% of, there's an asset compression at Centrelink level on the asset test. So that can be a very good layer to put in there to protect against that. But obviously the downside is the returns very low. But when you combine it with a scenario where you might be getting 2% in an annuity per annum and maybe 6% as being the Centrelink age pension return on investment per 100,000 you use, if you add 2% plus 6%, that total return of 8% is quite compelling, and it's guaranteed in nature. And one would argue that that's actually more stronger than balanced returns of sort of 6 or 7% in balanced portfolios. The top layer there, account-based pensions, again, full access. Historically have provided better returns than the other two layers, and it's very important that that layer is in there. And I obviously have to point out that can run out at some point, but it can be handy to provide an estate residual to beneficiaries. But this idea of having 3 of these layers all working together, again, it's getting back to consistency and reliability and not being too reliant on any form of your portfolio to provide those income amounts during retirement. The last thing I want to talk about on this point is the relationship between the bottom layer and the top layer. When stock markets go down or we have a pullback every 3 or 4 years, the age pension rises, generally speaking. And then when stock market returns are above average and you get a good return on your account-based pension, Centrelink goes down. So this inverse relationship is a very handy thing for retirees because, again, it helps to smooth your income amounts over the years, and that's what you really want. You really want stress-free income. Moving to the next slide now. Some other points to note here for those that are producing really good surpluses already. You might look to have some income splitting measures put in place. You might look to take advantage of those lower pension minimums as discussed earlier. Certainly capital gains tax events and the timing of those is a really important area to consider. High net worth individuals or people that have certain assets may look to take advantage of the timing of that, and that can really save thousands through your estate if done well. And all of these concepts, including the last income layering, we really recommend that you do obviously discuss this with your own personal advisor. Everybody's got a unique financial landscape and some of the nuances that you really need to discuss that individually. And we look at investment bonds as well. That's an investment tax structure that provides tax relief, particularly in the last 10 years of our life stage. And the last point there, depleting the higher taxed account-based pensions quicker than a tax-free account-based pension. Many of my retirees and yourselves might have 1 or 2 different account-based pensions segregated in such a way where you've identified that one is effectively the sort of the bad taxed account and the other one is the tax-free account. And you know, when you need to buy that car or renovate the house, recommendations around obviously trying to implode that taxable one first is a priority. So in summary, retirees, retirees need to enjoy retirement, particularly the first 10 years, and also, so there's no regrets, obviously, and also try and look to create consistency and reliability of your income streams. I'll hand it back to you, Nicola, to have a talk through other cash flow matters.
Thanks, Karl. Now, not everyone is retired, and we are entering into other parts of, we are in other parts of our life, particularly those that may be listening today and are in the middle of raising a family, particularly you're a long way off retirement and it may feel like your expenses are a lot higher than the income that you've got. And particularly sometimes it can feel that one member of a couple is working just to cover the amount of tax you pay, as well as the school fees that may be incurred. We see this, and I know especially it can be very tight, and you shouldn't really get too down on yourself when you're in this stage. If you're not feeling like you can save, think of things that you are currently doing. For example, if you're making repayments onto a mortgage and you're exceeding the minimum repayment amount, think of that as a form of saving. One of the key things, though, particularly when life is very busy at this stage and lots of things are happening, is making sure that you're working together and understanding what is important to each of you, particularly when you've got so many things going on. But as you move into the next stage and the children have left home or are getting to a point where they're not as financially dependent on you and you're looking at essentially retirement, this is a really neat time to really reassess your current situation from an income and expenditure side of things and see what measures you can do to maximise your income and potential surplus later on. Looking at strategies such as making contributions into super where you can get tax deductions like the spouse contribution and the government co-contribution. These can be little useful things to help you get to this stage of building your retirement nest egg. Looking at other things that you want to do to minimise your expenses, like repaying your debt down aggressively, can set you up for a really good retirement. But how do you do this? One of the key things, and I know that this is really quite the bit of homework I know I love giving to my clients, but they might not necessarily like hearing it, is what we call budgeting. It's one of those really necessary evils that is really important to understand what your income and your expenditures are. And even though it may seem overwhelming, it's interesting, or it's useful to understand your own specific spending patterns. Everyone does things differently. And if you're part of a couple, you should really discuss this frequently and make sure you're on the same page with what you're doing. If you want some kind of goal to work towards, the national household savings rate is actually just 11.6% of someone's take-home pay. So if you want a goal to work towards, that might be something useful. But make sure you're not looking at things that do come up regularly, but account for particular things that we don't necessarily plan for, such as speeding fines, parking tickets, etc. If you don't know where to start in terms of understanding what your current spending patterns are, there are some really useful tools out there to assist you in looking at this, particularly if you're not wanting to do everything manually through an Excel spreadsheet. If you head to FMD's website, we wrote an article recently around the top 5 apps to manage your finances. And these are some of the really popular online options that help people manage tracking their expenditure and what they're doing. So very much, I'd encourage you to look at our website if you would like more information on these. Now, once you've worked out where your money is going or where you may be overspending or potentially underspending based on what you want, you can look at reducing these areas or increasing them to meet your financial goals. And this is a particularly important topic that if you're wanting to understand how to work out what your goals may be, I'd encourage you to have a look at our webinar that we produced last month. But one of the key things in that webinar we talked about was around mindset and understanding your behaviour. When it comes to spending and saving and working towards a particular goal, understanding what it is that you're working towards and why this is important and how long it may take you to get there, it really does help you challenge some of the things that you may unconsciously be doing. It's very much like going to a personal trainer to try and achieve a particular goal. Think about budgeting or seeing your financial advisor around these areas to assist you in that measurement to achieve a goal that you may be working towards. But what are some of the strategies that you can simply take up now to help you build your surplus? This is something that Karl will talk about now.
Yeah, thanks, Nicola. I agree with that last point you made there on behaviours. I think that's really the key to creating that surplus. So, yeah, let's have a look at a slide now where we look at that. So building a surplus, I think that obviously income, we need to invest in ourselves, obtain more skills, stay marketable, and this can lead to higher wages. A statistic I read once was that the S&P 500 companies across the board would spend up to 7% of revenues every year on reinvesting back into themselves to keep competitive. R&D, research, or just more skills in their company. And I think as people, we need to take that on board. If we think, why wouldn't we put 7% of our own net income back into our own development or doing extra qualifications or skills, particularly if we get a tax deduction for doing that. But that's just a bit of a rule of thumb that I don't think we should ignore to stay competitive, because the income that we can earn in that working stage of our lives is quite important. The expenses is key to surplus, no doubt about it. And if you really can nail this whole pillar being creating a surplus, it's going to make the quality of your life so much easier in retirement and beyond, even for those around you. So nailing this expenses side of things it's fundamental. So periodically looking to reduce your costs, evaluating where's the money going, going through bank statements. You may need to look at online banking. We so quickly get caught up in paying for monthly everything, subscription, Amazon Prime, Disney Plus, Netflix. Do we need them all? Possibly not. Some people do. Unused gym memberships, you can turn them on and off. We need to look for better deals with insurances and mortgage rates. The bank's not going to come telling you that they're charging you too much. You've got to go and ask them. And personal debts and this trend lately towards afterpay and some of these nasty interest rates that you can get hooked into. So look to be very careful there. Moving to the next slide now. I think if you go into a really targeted and hard approach to your savings, you need to try and reward yourself every 3 months. Could be a theatre ticket, clothing item, or trip away, but you need to go easy on yourself. It's a tough little caper. So I'll obviously recommend developing better spending habits. Is it a weekly shop, freezing items at the supermarket, or just little things like that? When we think about it, there's a lot to financial planning and wealth creation that's out of our control. Laws change, and particularly portfolio returns, even property prices, a lot of it's out of our control. But what's in our control is this whole day-to-day cash flow management and creating our really large surplus. So that's in our control. So really go for it. I recommend to many of you to look to pay cash for items. It's not easy to do, and it's a bit old school, but it really does remind you where the money's going, and it does hurt sometimes. You're paying $20 for a hamburger or something like that. It's a bit confronting, and that's the idea. Being resourceful, sharing, family, friends, neighbours, items can be shared, saves costs. Understand also the equation around reducing your costs versus having to earn extra income. You really have to earn $2 of income for every dollar of expenses that you save. So that's just a feature of the tax system as a general rule. But that's really what's in your control, is trying to drop your expenses. And you don't have to live like a pauper. You've got a car, it's at the top of the hill, you don't have to turn it off when you go down the hill to save petrol. That's going a bit too far. So really go easy on yourself. And I think the key takeaways for people who are trying to create a surplus is to be tenacious. It's a day-to-day struggle, but to really apply yourself, and you'll get the rewards, but you do have to go for it. But at the same token, try and strike a balance between really tenacious application, but also trying to reward yourself from time to time. I'll hand back to you now, Nicola.
Completely agree, Karl. It's about getting that real key balance of enjoying life now, but saving for the future. And it can be a struggle sometimes, but worth it. So this brings us to the conclusion of our webinar today. And some of the key things that we've talked about has really been an interesting look at what COVID-19 has done to both our income and expenses, particularly over that last 18 months, and reassessing what we're doing. Each life stage is particularly different when you're looking at these two aspects of your financial situation. Someone's income and expenses can be relatively different. I know if you look at your parents, if they're retired compared to yourself who might be working and raising a family, or vice versa, if you've got children who are in the life of raising a family, working a job and paying down a mortgage. So everyone is different, and just remember to look at this. But once you have built a surplus, it's a question of what do you do with that money? Next time, we're going to take a look around some of the things that you can do, and particularly touch on different types of things such as superannuation, family trusts, or whether you pay down debt, or do you take out more debt, or do you donate to charity? So very much looking forward to hoping you can join us for that. So we do have time for a couple of questions. Karl, I can see one in the chat box, so I'll just bring that up. And just a reminder, anyone that's listening that may have a question, just go to the Q&A and we'll get through to them. So the one question that I have here is, in regional areas for rent, particularly when we were looking at the income at the start of the presentation, are we talking about domestic, I would imagine, residential or commercial properties?
I think it feels like this is a residential reflection, and the disbursement of people in population sense out to the areas outside of metropolitan. So many people just wanted to escape last year and have that freedom, and that generally means either moving out to your holiday house or a relative's home, or just taking out a lease. I've had a couple of friends who have moved out of the city in the last 12 months to try and have a better quality of life for themselves and their children. So I think undoubtedly from what I've picked up, it's the residential side. The real question is what's going to happen now with activity levels back into the metropolitan areas. I think there's a sense, Nicola, that the government's got a bunch of stimulus measures at the state level. They can't afford to have people decentralise into the country areas on wholesale amounts. I mean, they've got pipelines of 10 or 20 years of tunnels, hospitals, other infrastructure that it really makes sense, and it's cheaper for a country to be running these centralised metropolitan areas. So whilst it is a short and medium term thing, there's no doubt in my mind that even in January last year, I mean, we saw people flood back into the cities, and you couldn't even get a person to work in a cafe or restaurant. The demand for labour was really off the charts. So, yeah, I've got a question for you now, Nicola, if I can. And this really comes back to a question I had recently from a client where they were sort of feeling a little bit disheartened around the property market, and they're sort of saving. And their question really is, do you have any tips or thoughts around how I can get into that property market given what's happening with my cash flows and so forth?
That's a really good question, and particularly one that's very common, particularly as people are looking at saving for their first home. I think one of the key things when we are looking at saving for our first home is we really want to buy that forever home that many of our parents and our grandparents had. I know I did when I was looking at buying my first home. And one of the things that I think is really important to think about when you are looking at purchasing your first home is maybe build up to that forever home. Look at getting into an area that you can afford. It may not be everything you want, but looking at what you can compromise to get yourself into the property market and at least build some passive equity that way, particularly with the property prices they have significantly increased over the past essentially decade or so. So taking that on board and getting into one home with a view of maybe using the passive growth of income or doing some renovations to maybe increase the value to then sell and purchase using that deposit another home that is more in line with that forever home. It's very key not to get too disheartened when you're looking at particularly trying to work towards that really key goal that I think a lot of people, not just Australians, but us Kiwis as well, always have.
Absolutely.
So we do have time for one more question. Now, one thing that's particularly interesting for people is, are there any cash flow areas, or particularly when you're managing your cash flow, that you want to advise clients on? Karl, I know you're very interested in this topic as well. So do you have any of
I've just been surprised, I guess, Nicola, the last year or so, the way the banks have treated some clients who are in that sort of earlier stage of life where they're trying to buy a property or get a lending deal done. And so, looking really deeply into behaviours such as how much alcohol, is there sports betting or gambling on a regular basis, some of the measures around, Uber delivery, and some of these areas I don't think help our younger clients and can really bite you at that time of getting that loan. And it's I don't know whether it's the fact that some of these lending deals are being processed overseas, where some of the people looking at these applications might have a lack of understanding of the way we spend in our cities here. I don't know what it is, but I don't think it helps younger people who are trying to get lending done or take out a mortgage to have these regular spending scenarios show up on their bank statement. So I guess my advice is for younger clients is, if you think there's a purchase coming up imminently or a lending deal that you would like to apply for, just refrain, hold back, calm the farm for 3 to 6 months, and then maybe later on change. But you really need to tame the beast for a few months prior to applying for a loan.
Great tips there, Karl. Thank you. That is all that we have time for today. Please, if anyone does have any further questions around their situation, please contact your advisor. Now, we will leave you here, and please don't forget the survey that we will be sending you after this. We really do appreciate your comments and feedback, and we look forward to meeting you again in the next webinar.